Hello everyone, my name is Gifmo Maguju, and today I want to welcome you to another tutorial where we are going to look at National Foods Holdings. So today we are going to build a complete financial model for National Foods for the purposes of valuing its stock. And I must say that this tutorial is only for educational purposes, and it's there to guide you on how to build a financial model for a listed company, and also how to perform the valuation part of the stock. So without wasting time, let's dive right into it. So here we have got some tabs here. We have got the income statement, we have got the cash flow, we've got the balance sheet. So we're going to project the income statement, the cash flow statement, the balance sheet, the working capital schedule, the debt schedule, and lastly we look at the valuation for National Foods Holdings. So like I said yesterday that I always recommend that you build the model first and then worry about conducting extensive research once the model is completed. The reason being that if you start with research, you may spend more time trying to dig deep, into understanding a company, and that might take a lot of time. And if you are really pressed for time, you may not be able to complete the model in time. So here I'll show you a quick way to build a financial model, and then later you can dig into a company's annual report and come back to the model and change the assumptions. So let's first of all look at the annual report, the 2023 annual report for National Foods. So like I said yesterday, when you open in a listed company's annual report, look for operational highlights and also read the management discussion and analysis. That's where you can get a lot of information and insights that are key for projecting the company's financial statements, right? So here we can just scroll down a little bit. So let's just scroll down here. I'm just pressing the page down on my keyboard. So here these are performance highlights, so you can take a look. Here you can see we've got revenue, we've got operating profit, we've got share performance in 2023. At some point in 2023, the common stock price reached about 200 cents, right? So here this is the chairman's statement. So you can read this to get it, to appreciate what's happening with the company. And here let me just zoom in. Right here you are seeing the financial performance. So like for example, revenue is mostly driven by price and volume. So this is information that you need to track like for the past 5 years and see how much the volumes are growing per year. You can compute the COG. So here we are being told that volumes for the year were 553,000 tons. They were 3% below last year, which means they declined by 3%. And you need this information to be able to come up with near realistic revenue assumptions. And these are also operational highlights per segment. So here they are telling you that flour milling volumes for the flour unit reduced by things like. So you need to go through and be able to gather enough information to make informed assumptions or guesses about the future performance of the company, right? So basically that's it. So we can proceed and start building our model here. So we will be referring to this annual report as we are building our model. So let's go back there now. Perfect. So next to this one, this is a completed model with the assumptions. So I'm going to, for the sake of time, I'm going to use these assumptions to build out our model. So for revenue, let me just copy these ones. So I'll come here, I'll see where revenue is. Or before we do that, or before we paste, but for now, before we paste those assumptions, let's start by doing a bit of some historical analysis. So let's find out the year-on-year growth rate for milling and manufacturing revenue. So here we take the revenue for 2023, we divide it by revenue for 2022 minus 1. And here we do the same, we take revenue for 2023 divided by 2022 minus 1. And then we do the same here as well, minus 1, right? So we are seeing that the revenue for 2023 grew by 22%, right? And here we want to perform sort of a common size income statement where we are trying to express the income statement line items as a percentage of revenue. So in other words, we are saying all these other items we want to project them as driven by revenue. So here we take this and we divide by revenue, and then we copy to the right. And then gross profit, we divide it by total revenue, and then we also divide that by total revenue, and we divide the total cost, so it's equal negative divided by total revenue, and then we copy that. Then EBITDA margin, we divide that by here, we copy that to the right. Depreciation, today we just project it as a percentage of revenue. So here we copy that to the right. And then EBIT margin, we divide it like that. And here the income tax divided by earnings before tax, just like that. Then net profit margin, we divide it by total revenue, just like that. So we turn that into percentage. Let's just cross check once more. Okay, so I think that's okay. So row 9, that's our total revenue, right? So here we can just compute the basic and diluted. So we take the profit for the year, we divide that by basic and diluted share count, we multiply by 100, and then we get 18.13 cents. Right, so it's time for us to now project the income statement, right? So now we can make use of these assumptions. So here we are projecting that revenue is going to grow by 7% in 2024, and let's also check our projections for cost of sales. What else? For other income, for costs, what else? For depreciation, okay, that's the wrong one. So here depreciation, and what else? For we're going to use the the income tax rate, right? So here we copy that and then we paste it here. Perfect. So these are going to be our assumptions, right, that are going to drive this business, okay, that are going to drive National Foods Holdings. Okay, so without wasting time, like here we are saying these are zeros here, and we have no information about these items, so we just copy them to the right. And here we want to project revenue. So what we are going to do is we select revenue for 2023, we multiply it by the revenue growth rate, and then we copy that to the right. And then here what we do is we multiply by revenue like that, and here all we need to do is to copy these formulas to the right, and here we multiply by revenue, and then here we need to select this and then we multiply by revenue. Okay, so here, so we say we selected this forecast for 2024 and we multiplied it by revenue for 2024, right? And then we can copy that to the right, and we're also going to do the same for depreciation. It also depends on revenue, and we also copy that as well. So for now we don't have, for now we are going to leave interest income and interest expense as blank. We are going to project that in the debt schedule. So here financial loss, let's find out what it is. What is financial loss? Okay, so financial loss, here we can do a quick word search and then write financial loss. Let's see. Okay, so let's just find out what it is. So here if we come to note 5.3, we see that financial loss is exchange differences on foreign denominated balance. So that is a difficult line item to model. So we get that to 0. Then we've got equity accounted earnings. It's also difficult unless we get information from the annual report. So after the model, then we can go back to the annual report and dig deep into these line items that we have put zeros on. And here what we are going to do is we multiply the tax rate for 2024 multiplied by earnings before tax for 2024, and then we copy that to the right. Okay, and we copy that to the right as well. Okay, and here we can copy that to the right, and here we are going to assume that this share count will remain the same, so we just copy that to the right just like that. Okay, so for now our income statement is complete. Is not yet complete because we haven't projected interest income and interest expense, but as of now I think we are good to go to the cash flow statement. So let's go to the cash flow statement now. So here let's link the earnings before tax for 2024. Okay, so let's link that, and let's leave interest income, interest expense blank, right? So here let's link depreciation for that's 2024, and here we have got allowance for obsolete inventory, allowance for credit losses and stuff. So for now we can just put zeros here, and then we can come back and we will go to the annual report, and you can go to the annual report and dig deep about these, and then be able to and see how best you can project these ones. obviously the allowance for obsolete inventory, allowance for credit losses, they've got a bearing on our cash flow. So we really need to find ways to project that. And then unrealized foreign exchange losses, so here we're also going to put 0 there. Then other assets, we don't have much info on that. And then financial loss, profit on disposal, we don't have. And then equity accounted earnings, we will put zeros for now so that we can proceed to the next. Right, so here we will need to project the working capital items, so we'll come back to that. Let's scroll down a bit. So here we want to see the capex rate as a percentage of revenue. So we divide capex for 2022 capex by revenue by 2022 revenue, and we can get that in the income statement. So this is 2022 total revenue, and then we can copy that to the right. And then that was capex to maintain operations, and then we do the same for growth capex, right? And that's fine. And so for these ones, we're going to put zeros there, project them as 0. The same here. For now, we can put them as 0. And I think that's fine. Then let's copy our projections for the cash flow statement. So these are our projections. So projections, and let's also copy these assumptions and paste them here. And let's forecast capex here. So negative multiplied by revenue for 2024. So we copy that through, and we do the same here. 2024 revenue, and then we copy that to the right, just like that. Okay, so income statement G9. So this is G9. Okay, so now we can copy that to the right. Okay, so you really need to make sure that your formulas are working. Okay, so here, like I said previously, you audit your formulas by pressing F2. And here what we need to do, there are two ways that I normally use to project dividends. Sometimes I use dividend payout ratio, and sometimes I use dividend dollar per share. So dividend dollar per share is, if we don't have that stipulated in the annual report, we normally identify the trends from the previous dividend dollar per share. So we compute them as historical dividend divided by the number of ordinary shares. So that's what we did there. So say this one divided by the number of ordinary shares, like that, and then we copied that. So let's look at here. So let's just copy that and then paste the assumption there. So now we can easily project that by multiplying by the number of shares for 2024. Okay, so this is another way, and you can also use a dividend payout ratio. I'm sure it will give you a different answer here, but all the same. So for now, here we can put some zeros here. So let me just copy that and just highlight them as blue. So here we are saying this is proceeds from borrowings, this is repayment of borrowings, and from them, if we go to the balance sheet, you see that this company doesn't have long-term debt. So this is obviously short-term debt. So we just need to say here short-term debt. So let me just write short-term borrowings, and then I say okay, sorry, so here I can say repayments or an issuance. Okay, so what I need to do here is to come here on the formula bar, and then I add this, okay, repayment of borrowings. And I also want to do the same here, and then I add repayment of borrowings, just like that, such that I can delete this. Okay, so I think that was premature. So here I can copy and turn that into values, Alt ES, and then turn that into value. And then here I can easily delete that. So that will also give me this. Okay, so I can just go just to cross check in this other model. So I can cross check which other model I'm looking for. Okay, this one. So here I can come and cross check. This is 932 and then this negative there. So 932 and this negative, which is correct. So here I think we can copy that to the right, and for now I think that's okay. And we can, I think for now, what we need to project the changes in working capital. Okay, so to do that we will go to the working capital schedule. So here we want to find how many days does National Foods take to process its inventory, and how many days does it take to collect money from its debtors, and how many days does it take to pay its creditors. So here we're going to say average, and then we divide that by negative cost of sales for 2023, and then we multiply by 360. So we are multiplying by 360 to avoid some decimal places. We just want a rounded figure. And then here we do the same, average, and then we divide that by revenue for 2023, and then we multiply by 360. And then lastly we do this, we divide by negative cost of sales for 2023. I think that was so multiplied by 360. Okay, and then we get 61. So let's get our other estimates here. So working capital here, just use 62 throughout, 62 throughout, 36 throughout, 61 throughout. So we can just do the same here. So we can copy that right through, and we can also copy that right through, and we can also copy that through. So here we want to project the inventory level or inventory balance. So what we are doing is we are selecting the number of days divided by 360 days multiplied by negative cost of sales for 2024. So we do that, and then we copy that right through, and we do the same here, divided by 360 multiplied by revenue for 2024, and then we copy that to the right, and then on totals we copy the totals to the right, and then here we divide that by 360, we multiply by negative cost of raw materials or cost of sales. Okay, and then we copy that. So So here we copy that as well. So that's current assets minus current liabilities. We copy that as well. Then changes in working capital. Then we take this, we say minus this, and then we copy that to the right, just like that. Okay, so now it's time for us to link that through here. So here we're going to say equals negative, and then we go back to the working capital schedule here, and then we select that, we say minus this. Okay, and then we copy that to the right, and we do the same here. Negative, we open here, and then we come back again, say negative this, and then we close, and then we copy the formula to the right. Right, and then we also link through accounts payable, right? So what we do here is we just go back to the working capital schedule, and then we subtract that, and then we press OK, and then we copy that to the right. Okay, and then we come here, we copy that as well. So the way to see that this here, it is to match with what you have. So here this will be positive, but in the cash flow statement it should be negative. Okay, so this is also one way you can check that. And then here we leave these blank. We are going to project them, right? So for now I think we can just copy that through. And what else? So here we can just so here we can just put that as a 0, right? And then copy that to the right, and then copy that to the right as well. Okay, so here we do that. Okay, and once we do that, then we have to go to the balance sheet. Now it's time to project the balance sheet, okay, using the cash flow statement. So like I said that we are using the cash flow statement to project the balance sheet. So the way to go is you find in a cash flow, a line item in the cash flow statement that affects the balance sheet item. Okay, so here we have got property, plant and equipment. So we say this minus. Okay, so we choose, we subtract depreciation. We also subtract capex to maintain operations, and in other words, we are not subtracting, but we are adding, because these figures are in negative, and then minus this as well. Okay, then we can copy that, and then we want to find a line item that is linked to investment property. So we go to cash flow statement. Then let's look for that investment property. I think we don't have, so that one we are going to link. We're going to link it, and then goodwill. Do we have anything to do with goodwill here, or intangible assets? We don't. So for now we just link this through, right? And investment in associates, let's just find out, do we have anything to do with investment in associates? We have, so loans to associates and this. So here investments in associates, so here say negative, we find loans to associates, and also these ones. I think that's all, and then we copy that to the right, and then other assets, we also have got other assets, and then we find increase and decrease in other assets, and then we copy that to the right. Then right of use assets. Here, let's just link that through. Okay. Then we copy that. Then inventories. Then you say select this, and then we come to the cash flow statement. We pick this. We pick this. Okay, and then we copy that. So let's see. So we're saying we have got an allowance for obsolete inventory. So I think we can correct that. So we can say this minus allowance for obsolete inventory, this, and then minus this. Okay, so it makes sense. And then trade receivables, we do the same, minus allowance for credit losses. So here minus allowance for credit losses, and also minus receivables here. Okay, and then we copy that, and then other assets. So here other assets, do we have? We don't. So other assets, we're going to link that through, and then we've got current tax receivable. Okay, current tax receivable. So this one we just link it through as well, and then this one we add changes in cash and cash equivalents for 2024. Okay, and then we copy that to the right, and then we highlight that, and then we copy that as well. Okay, and then here we don't have info about issuance of shares, we don't have info about revaluation reserve, we are only left with distributable, which is retained earnings. So here we're saying plus. Okay, we add profit before tax, we say plus interest income, plus interest expense, plus unrealized foreign exchange gains, plus financial loss, plus profit on disposal, plus equity accounted earnings, plus net interest expense, and then plus dividends, right, dividends, and also plus this. Okay, and then we copy that to the right. Okay, so let's come back to other assets. I think I want to see something. So here we also have got other assets here. So other assets, we can say negative. There was an other asset that I saw here, so here we can link that through here. Okay, and here deferred income taxes, we just link that through. We no longer have long-term lease liability, we just link that, just put it as 0, and then trade and other payables, plus we find here, and then we copy that to the right, and then current portion of lease liability. So we just take that, we say plus current portion of lease liability, and then we copy that to the right, and then borrowings, these are short-term borrowings, right? So we say plus and then we choose that here, and then current tax payable. So we take that, we link it with income tax paid, okay, and then we copy that to the right, and shareholders dividends, so that one we can copy that through, and then we can copy that to the right, and we can copy that. So we see our balance sheet is now balanced, so we can now proceed to project the debt schedule. Okay, so now we can go to the debt schedule. So the reason, so like I said before, that we work on the debt schedule after the balance sheet, right? Because first of all, we have to make sure that our balance sheet is balancing, and then we can work on the debt schedule. So here, let's start with cash and cash equivalents. So the balance for 2023 will be the opening balance for 2024. So let's go and pick that. So here we take the 2023 balance and cash at the beginning of year. We come back and link that as well, right? Then we also link cash flow before debt paid down. Okay, so we want that as well, and then we can copy that to the right. So let's just estimate, just add code minimum cash cushion, and then here we can add that. So now we have got cash flow available to pay debt, which is a lot of money that's available here. And let's model out the short-term debt. So let's link the balance from the balance sheet for short-term borrowings. So this is the short-term balance, and then let's link this up, and then for now let's just put some zeros there, and then let's copy that, and let's close there, and let's do that. And let's also do the same for short-term lease liability. So short-term lease liability, we can do the same. So here 0, 0, and then we can add that, and then copy that through like that. So if you notice that in the balance sheet we no longer have the balance for lease liability, we no longer have lease liabilities. So here I'm just going to delete this part here. So let me see. So I'm just going to delete this part here, the long-term lease part, because we don't have that. So here, perfect. So now all I need to do is total issuances. I'll just come here and add here mandatory issuances and repayments, non-mandatory, and then we can copy that. And here the closing balance for cash is going to be the beginning plus cash flow before debt paid down and plus issuances, repayments and issuances, right? So now I think we can safely copy that to the right, so we can bold as well, right? And now I've got some historical information, right? This was the interest rate that I computed, the short-term lease based on historical data. So we've got debt interest expense 35%, which is too high. So what I did is I took this debt interest expense for 2023, and then so if we go to the annual report, let's look for the breakdown for interest expense. Okay, so let me zoom in that. So here you can see it's saying this is the breakdown for interest. This is interest income. Interest was earned from positive bank balances. Interest expense on lease liability, interest expense on short-term borrowings. Okay, so yeah, so for now let's just input these ones. So here for short-term debt, let's just put 35%. So we will go into the annual report and look for more information on loans. Okay, and then here for short-term lease liability, let's just 20%. So let me just confirm on this other one. So here I put 35. Okay, so she's okay. So let me just come here and then compute the interest. So multiplied by the interest. Then I copy to the right. So average date multiplied by, and that's okay, right? So now we want to add this total interest expense. So total interest expense plus this, and then we copy that right through. And for this one, which one did I use? I used 3%. I used 3%. Okay, let me just use that 3%. Let me just use the average here. So average times that, and then perfect. Okay, so I think here we can close the historical, and yeah, so it's looking good so far. And we need now to link to our income statement. Okay, so here we are going to link the interest income from the debt schedule. Okay, so let's link here. Let's link that, and here let's link total interest expense, which is this one. Let's link that. So now our income statement is complete. And by the way, in some cases you may face challenges with circular references. So when it does on your side, then you can come on file here and come here on options, and then come on formulas, and then you tick here where it's enable iterative calculation, and that will help. And then here we are going to link. So here we are going to link the income. So we link here, and we also come here interest expense, we link that as well. Okay, so we link that, and then we also come here and we link that. So here we are going to link this plus this. So we copy that to the right. As for now, here we just put a 0 there. All right. So all the same, our cash flow statement is also now complete, and the balance sheet is still in balance. And we've built this, we have built this, and what's next, what's left here? So here I think I can turn this into right. So what we have to link these debt items here with the debt schedule. So to do that, we have to come, let's say, equals, and then we link with the short-term debt, right? So under short-term debt, we're going to add mandatory and non-mandatory issuances, okay? And then we press enter, just like that. We do the same here. We link with the mandatory and non-mandatory issuances, and then we copy that. So I want you to watch something, that if we say this company is going to pay, let's say 197 here. So let's say it's going to pay, so paying, it means 197 is a negative, then we get zeros there. So that will also change in the balance sheet, because when we come in the balance sheet, you will also see that this has changed, and also this is, our balance sheet is still in balance, and we can also check here in the cash flow statement the changes that we have made here, and these changes will also flow to the income statement, right? So you can see here in the income statement, these changes also are reflecting there, okay? So so we can come here in the debt schedule. You can see here that from 2026 up to here, the interest expenses is changed. So sometimes this is now, let's say you want to do an analysis of, let's say if National Foods Holdings is to pay its debt today, all of its debt today, what will be the impact on the income statement, cash flow, and balance sheet? And you may also need to, let's say you are just trying to assess which is cheaper, debt or equity. You can also make use of this, right? And that will also help a lot. So here let's return to 0, and this is a tutorial for another day, where we are going to build a model just to assess whether it's feasible for a company to raise debt or equity. So as of now, I think our financial model is complete. So you can see here it's complete, and we are done, okay? And everything is intact. So now back to the valuation. So now we are in the valuation part. So we want to determine the intrinsic value of this, and now I want us to look at the balance sheet. So if you come to the balance sheet, you will see that this company does not have long-term debt, right? It does not have long-term debt, and in most cases we use unlevered free cash flows for companies that either funded by debt, by companies that are funded by both the debt and equity. So we use unlevered free cash flows. But in this case, where we don't have long-term debt, I thought it fit to use cost of equity as the discount rate, and we no longer compute the unlevered free cash flow, but we use free cash flows to equity. So if we are using free cash flows to equity, what we do is we take net income, we add a depreciation, and we also less so in other words, we take net income and then we add reinvestment. So reinvestment is depreciation minus changes in working capital minus capital expenditures, and we add net borrowings. So this is reinvestment. Okay, so what I'm saying, let me just highlight that. So what I'm saying here, if I create a border here, let me just do this. So if I say control 1, I want you to understand this. Okay, so I come to what do you call it, to border. Okay, and then to border I just click here, just here and here. Okay, so I'm saying all of this that is within a border is we call it reinvestment. Okay, so this is reinvestment, depreciation, changes in working capital, capital expenditure, right? So we are saying net income plus this reinvestment plus net borrowings, okay, which is issuance minus repayments. Okay, so now let me just unboard this so I can go back again and just turn off this. Okay, and then okay. So what we are going to do is we are going to link the net income for 2024 from the income statement. So this is profit for the year. So we take that and then we copy that to the right. And then we take depreciation from the cash flow statement. So where is depreciation? Here is depreciation. And then we copy it down. We copy that, and then we link as well changes in working capital. Right, so we link as it is. Okay, so here we are linking that, and then capital expenditure, right, we link that as is. So here what we do is we add capex to maintain operations and capex and growth capex. So here we can copy that, and net borrowings, we can also come here in the cash flow statement under financing activities, short-term borrowings, we link here, and then here all we need to do is to sum all this. Okay, and then that's it. And here in under perpetuity, that's 2028 cash flows, we just take these ones, and here right, so let's talk a little bit about the discount rate. So the cost of equity here, this is not realistic. Okay, this is the discount rate that I just came up with. So I've used the 10-year US Treasury bill rate, which is around 4.31%, and beta, obviously beta for National Foods is the stock is not that volatile, so it's obviously less than 1. So that's why I just estimated 0.8 there. And then I also used the equity risk premium, which I got from Asworth Damodaran's website, which is about 17.17%. So that so to compute cost of equity, you just say risk-free rate plus beta multiplied by risk premium. So this is what I did. So now it's time to discount the cash flows. So here I'm going to discount that by 1 plus the discount rate, and I anchor that, and then to the power 1, and then I can copy that to the right. And then here let me just total the, so here I can write total, so I can write total discounted FCFE, right? So here I can sum that, and then that's it. And then here That's the growth rate, right? Perpetual growth rate. So there's also another way to find out about the sustainable growth rate. So let's just do a little some maths here to compute the, what do you call it, sustainable growth rate. So let me just write sustainable growth rate for the firm. So here we compute, what you call it, dividend payout ratio. Then we compute retention rate, and then we compute ROE. Okay, so let's do that, historicals. So let's compute the historicals. So historical dividend payout, okay, so let me just come here and cut this, and let me paste that here. Okay, I think that makes sense here. So if I come here and if I say negative, and then I go all the way to the cash flow statement, right? And then I divide that by net income, okay? And then I copy that. Okay, so we get a dividend payout ratio of 46.85, right? And then here retention is simply 1 minus the dividend payout ratio. Okay, so here that's 54% and 15%. Okay, and then ROE, we're gonna say net income divided by average equity. Okay, so 2023 this divided by average equity in the balance sheet. So equity here, so we get 7%. Okay, so sustainable growth rate now. So sustainable growth rate becomes the retention rate multiplied by ROE. So you see, that's the sustainable growth rate for national foods. That is for, so here we can even put that here like 1.1%. okay, we can put that here, and then let's try to compute the terminal value. So here I'd say times 1 plus this, right, divided by this minus this with close bracket, right? And then we say we discount that 1 plus 18 to the power 5. Okay, so if we come here, we're gonna add that plus this, and obviously we are going to link this, and then we can divide that. So that gives us 1.6. okay, 1.6 right, is the share price. So here let me come and say currency and just put $1 there. Okay, so that gives us $0.6. Right, so, and if we change here, we say, let's say 2% or 3%, like what we were, so you can actually see, so using that for 1.6, you can see that it's $0.6. that's 1.1. Okay, so it gives us 1.6. That's estimated equity value per share. And if we say current share price, let me just check on my phone here what's the share price was for this company, right? So here, let me just come here and check a little bit. So National Foods Holdings share price. National Foods share price today. Let me just come up here. Today. Let me see how much it is worth today. Okay. So it's around here I'm getting, so what I'll have to do is I'm getting 127.56 cents. So to turn that into dollars, what I'll do is I'll say 127.56. Now must I divide by 100? Okay, so if I say, okay, something like that. So I think that's okay. So let me just customize that. Perfect. So that's so here I think we can see that's a 26 upside potential. So this is 1.3, right? The current share price is 1.3, and this is it. So yeah, this is it, guys. This is how you perform the DCF valuation method using the free cash flow to equity, and I think that's okay. So yeah, I hope you have enjoyed this tutorial, and I humbly ask you to subscribe to our YouTube channel, and also if you've got any views, if you've got any additions and comments, please feel free to let me know. And if you've got any company that you want me to look at, please also let me know. But please don't forget to subscribe to our YouTube channel and share these videos with other peers who may want to learn financial modeling and who may also want to learn how to value listed companies. So thank you so much, and I love you all.